Hey everyone, let us talk about something I know a lot about. Making financial blunders. I used to be that guy, young, eager, and totally clueless about how money really works. I was always chasing the next big thing, the hot stock, the insider tip. It was a fast track to losing a lot of hard-earned cash. Trust me, I thought I could get rich quick. Who doesn't he want that right? I bought into the hype, the high returns promises, and the idea that I just needed to be in the right place at the right time. But guess what? There is no right place or right time when you are just gambling. I jumped into short-term trading, lost big, fell for scams, lost more. I put all my eggs in one basket, ignored risk, and let my emotions drive my decisions. It was a disaster, a real painful wake-up call that emptied my savings account. Every penny I had worked so hard for, gone. It felt awful. Like a punch to the gut, it forced me to stop and really look at what I was doing wrong. After that painful experience, I realized I needed a completely different approach. I stopped chasing quick profits and started learning about real finance. I learned about long-term investing, diversification, and the importance of not putting all your money into one risky asset. I traded the adrenaline of day trading for the peace of mind of steady growth. I am not saying it was easy. It took time, patience, and a lot of unlearning, but it was worth it. Now, I focus on steady growth and protecting what I have. I am here to share those painful lessons so you do not have to make the same mistakes I did. I want to help you build a solid financial future without the drama and the heartache. Let's talk about some common investment traps that many young people fall into. The first one is the fear of missing out, or FOMO. This is where you see everyone else making money on a certain stock or crypto, and you feel like you need to jump in too, even if you do not understand what you are investing in. I did this so many times. I saw friends bragging about their gains, and I thought I was missing out on easy money. So I would dive in headfirst, usually right before the market corrected, and I would end up losing money while everyone else was taking their profits. It is a classic beginner mistake. Another big trap is listening to anonymous tips or social media gurus. There are so many people online claiming to have the secret formula to wealth. They promise guaranteed returns or tell you about obscure stocks that are about to explode. I fell for some of these. I would read some forum post or watch some YouTube video, and I would think, this person knows what they are talking about. I would invest based on their advice, only to find out they were just pumping and dumping, or they had no idea what they were doing either. Always do your own research. If it sounds too good to be true, it probably is. Then there is the trap of not understanding risk. When I started, I thought risk was just about losing money, but it is more than that. It is about understanding how much you can afford to lose and how much volatility you can handle. I used to invest money I could not afford to lose, thinking I would just make it back quickly. That is a recipe for disaster. You need to understand that all investments carry some risk, some more than others. Stocks are riskier than bonds, for example, and some individual stocks are much riskier than a diversified index fund. Start small, understand what you are getting into, and never invest more than you are comfortable losing. Another mistake is emotional trading. This one is huge. When the market is going up, you feel confident, maybe even a little greedy. You want to buy more. When the market is going down, you feel scared, anxious, you want to sell everything to stop the bleeding. I made both mistakes. I bought high because of excitement and sold low out of panic. This is the opposite of what you should be doing. Successful investing requires discipline and a calm, rational approach. Set a strategy and stick to it, even when your emotions are telling you to do something else. One thing I learned the hard way is the danger of leverage. This is borrowing money to invest. It can amplify your returns if things go well, but it can also amplify your losses dramatically. If things go south, I dabbled in leverage trading, thinking I could accelerate my wealth. It was a disaster. I ended up losing more than my initial investment because I had borrowed money. For young investors, especially, avoid leverage unless you are an experienced professional and fully understand the risks. For most of us, it is just too dangerous. And then there is the trap of not diversifying. I used to put all my money into one or two stocks that I thought were sure things. Of course, they never were. When those stocks tanked, my entire portfolio went with them. My entire financial future felt like it was crumbling around me. Diversification means spreading your investments across different assets, industries, and geographies. This way, if one investment performs poorly, it does not wipe out your entire portfolio. Think of it like this: do not put all your eggs in one basket. It sounds simple, but it is a lesson many of us learn the hard way. Building a solid financial foundation starts with some basic principles. First, learn about personal finance, understand budgeting, saving, and debt management. Before you even think about investing, make sure your financial house is in order. Have an emergency fund, pay off high-interest debt. These are the boring but crucial steps. Second, develop a long-term mindset. Investing is a marathon, not a sprint. Focus on slow and steady growth rather than quick wins. Compound interest is your friend. The earlier you start, the more time your money has to grow, even small. Consistent contributions can add up to a substantial amount over decades. Third, educate yourself continually. The financial world is always changing. Stay informed, read reputable financial news, and understand the basics of different investment vehicles. But be critical of what you read and hear. Do not just blindly follow trends. Fourth, consider low-cost index funds or exchange-traded funds, ETFs. These are diversified by nature, and they offer a simple, cost-effective way to invest in the market without trying to pick individual winners. They are a great starting point for beginners. Fifth, seek professional advice if you need it. A good financial advisor can help you create a personalized plan and guide you through complex decisions, but make sure they are a fiduciary, meaning they are legally obligated to act in your best interest. Sixth, regularly review and adjust your portfolio. Life changes, and so should your investment strategy. Periodically check if your investments still align with your goals and risk tolerance. Do not just set it and forget it forever. Finally, understand that mistakes will happen. Even experienced investors make them. The key is to learn from them and not let them derail your entire financial journey. Do not be too hard on yourself, just get back on track. I am living proof that you can come back from investment failures. It is about changing your mindset, ditching the get-rich-quick fantasies, and embracing a sensible, long-term approach. Your financial future is worth the effort. Let us learn from these experiences together and build a more secure future for all of us. Remember, slow and steady wins the race in investing. Focus on building habits that serve you well in the long run. Good financial habits are the real secret to financial success. Not some magic stock tip. Do not chase the shiny new thing. Build a strong foundation, save consistently, invest wisely in diversified assets. Understand the power of compounding. Avoid debt. These are the boring truths that actually work. My journey started with a lot of pain and regret, but it led me to a much better place. I am no longer stressed about every market fluctuation. I have a plan, and I stick to it. I want that for you too. It is okay to start small. What matters is starting. Take that first step towards understanding your money better. It is the best investment you can make in yourself. Let me tell you a bit more about how my get-rich-quick mentality truly messed things up for me. I remember one particular instance. A friend of a friend told me about this incredible opportunity. It was an investment in a new tech startup, the kind that promised exponential growth and talked about disrupting an entire industry. They had a slick presentation, fancy jargon, and showed projections that would make anyone's head spin. I was convinced. I poured a significant chunk of my savings into it. It was money I had diligently saved from my part-time jobs. I dreamt of quitting my job and living off the returns. The reality, of course, was much different. The startup never really took off. The founders disappeared, and my investment vanished with them. It was a hard pill to swallow, realizing I had been completely conned. This experience taught me a crucial lesson. Never invest in something you do not fully understand, especially if it relies on promises of overnight riches. Real businesses take time to grow. Real investments have risks that are clearly communicated, and if someone is trying to rush you into a decision, it is probably a red flag. Always take your time, ask questions, and consult with independent sources. Another time, I got caught up in the hype of a certain cryptocurrency. Everyone was talking about it. The price was skyrocketing daily, and I felt like I was missing out on a once-in-a-lifetime opportunity. I bought in at what I thought was a reasonable price, but the momentum carried it even higher. I saw my investment double, then triple. I felt like a genius. I ignored all the warnings about volatility and the lack of underlying fundamentals. I was convinced it would keep going up forever. Then, as quickly as it rose, it crashed. I watched my gains evaporate, and then my initial investment started shrinking too. My emotions were a roller coaster. One day, I was on top of the world. The next, I was in despair. I held on, hoping it would rebound, but it kept falling. Eventually, I sold at a significant loss. Just to stop the bleeding. The lesson here was painful, but clear. Chasing speculative assets, driven purely by hype, is not investing. It is gambling. And while some people get lucky, most do not. True investing is based on research, understanding the value of an asset, and having a long-term perspective. It is not about riding a wave of speculation. The concept of financial security was foreign to me when I was younger. I thought financial security meant having a lot of money in the bank, but it is more than that. It is about having a plan. It is about having an emergency fund that can cover several months of living expenses. This was something I completely neglected. Every spare dollar I had went into my investments, leaving me vulnerable to unexpected expenses. When my car broke down or I had an unforeseen medical bill, I had to dip into my already depleted savings, or worse, use credit cards, incurring more debt. This created a vicious cycle. Without an emergency fund, I was always playing catch-up. I was always one unexpected expense away from financial trouble. It took a lot of effort to build that emergency fund after my early mistakes, but it is perhaps the most important financial safety net you can create. It provides peace of mind and prevents you from making rash financial decisions out of desperation. I also want to emphasize the importance of understanding fees. When I first started investing, I had no idea how much fees could eat into my returns over time. I was using trading platforms with high commissions, and some of my early investments had high expense ratios. I thought these small percentages would not make much of a difference, but they do. Over decades, even small fees can significantly reduce your overall returns. It is like a tiny leak that slowly drains your bucket. I learned to look for low-cost index funds, ETFs, and brokerage accounts with minimal fees. Every dollar saved on fees is a dollar that stays invested and grows for you. It is a detail that many beginners overlook, but it is incredibly important for long-term wealth building. Another big blind spot for me was taxes. I never really thought about the tax implications of my investments. When I did make a profit, I often forgot to account for the capital gains. Taxes I would owe. This led to surprises come tax season and sometimes forced me to sell other assets to cover the tax bill. Understanding how taxes affect your investments is crucial. There are tax-advantaged accounts like IRAs and 401(k)s that can help you defer or even avoid taxes on your investment growth. I wish I had started using these much earlier. It is not the most exciting part of investing, but being tax efficient can save you a lot of money in the long run. Learn about different account types and how they can benefit you. The constant need to check my portfolio was also a major problem for me. I would check it multiple times a day, sometimes every hour. Every dip felt like a personal failure, and every gain made me feel euphoric. This constant monitoring fueled my emotional trading and led to impulsive decisions. It was incredibly stressful and unhealthy. I eventually learned to detach myself from the day-to-day fluctuations of the market. Now, I check my portfolio much less frequently, focusing on the long-term trend rather than the short-term noise. Investing should not consume your life. It should be a tool to help you achieve your goals, not a source of constant anxiety. Set it up, monitor it periodically, and let it do its work. For young people just starting out, one of the most powerful tools you have is time. The earlier you start investing, the more time your money has to grow through the magic of compound interest. Even if you start with small amounts, those consistent contributions over many years can grow into a substantial sum. I wasted valuable years chasing speculative gains instead of focusing on consistent long-term growth. If I could go back, I would tell my younger self to start immediately no matter how little I had and to focus on low-cost diversified index funds. The power of compounding is truly incredible, and it is the closest thing to free money you will find in the financial world. Do not underestimate it. Finally, I want to talk about financial education. It is not something they teach you in school, but it is one of the most important skills you can develop. I learned everything the hard way through painful mistakes, but you do not have to. There are so many free resources available today: books, podcasts, reputable financial blogs, and videos like this one. Take the time to educate yourself. Understand the basics of economics, investing, and personal finance. The more you know, the better decisions you will make, and the less likely you are to fall for scams or make impulsive errors. Investing in your own financial education is the best investment you can ever make. It empowers you to take control of your financial future and make informed choices. My journey has been a winding road filled with expensive lessons, but those lessons have transformed me from a naive, eager gambler into a prudent, disciplined investor. It is a journey I wish I had started with more wisdom, but I am grateful for the perspective it has given me. I am no financial guru, just a regular guy who learned from his screw-ups. And if my experiences can help even one person avoid some of the pitfalls I encountered, then sharing my story is worth it. So take a deep breath. Do not rush. Educate yourself. Build your financial foundation brick by brick, not by trying to build a castle overnight. Your future self will thank you.